welcome back, everyone. Hopefully you are all looking forward to a very exciting panel on internal controls and audit. People probably thought that exciting and internal controls and audit don't necessarily go together, but I think with my panelists here today, I think you will agree with me at the end of this. So before we start, perhaps if we could just make very quick introductions of ourselves and where we are. So Zubin, if we start with you.
Good afternoon, everyone. I'm a chartered accountant by qualification, but I've been in the field of compliance, AML, and regulatory since 18 years. I currently work with Julius Baer, where I'm head of compliance, AML, and risk.
Thank you.
Hi, everyone. My name is Amaan Wali, Group Head of Risk and Compliance at Tarabut Gateway. Been in the industry for almost 15 years now, and by qualification, I'm a certified management accountant and certified internal auditor. Thanks.
Hi, everyone. I'm Ramesh Gopal. I've been in the banking industry for over 2 decades now, and predominantly in this region. Currently, I handle the risk management for Deutsche Bank. Academically, I'm an MBA, CFA charter holder, and an ACS.
Good afternoon, everyone. My name is Zsombar, and I'm the Chief Compliance Officer for United Arab Bank, previously with Citibank and HSBC. And I'm looking forward for this exciting discussion now.
Thank you very much. And just for those that don't know me, my name is Stephen Millington. I'm a Managing Director with the Secretariat, looking after the Global Investigations and Compliance function, and I am also a Chartered Accountant by training for it. So it's a panel dear to my heart. But I think as we, perhaps if we can start, there's always been, when we talk about internal controls and audit and all of this sort of topic area, there's always this, whether it's perceived or reality, I think, speaking, there's some reality within the perception in terms of the balance between the preventative and the detective side of things. People are very willing to spend money when things have gone wrong to fix them and to work it out. They're always a little bit more reluctant to spend money, time, and effort in doing that preventative area for it. And maybe Amaan, if we can sort of kick off with perhaps just giving a bit of a background to what you see as the difference between the preventative versus the detective side of those internal controls.
Sure, Stephen. Yeah, so preventive controls, as the name suggests, are the controls that are in place to prevent a failure or an error or a fraud from happening, right? So these are the controls that the institution puts in place to proactively safeguard the organization from issues. So just to give people an example of that, one of the main types of preventive controls that are instituted in banks and other FIs would be around segregation of duties, where you have different departments taking a different leg of the transaction just to make sure nothing goes wrong. Another example of a preventive control could be like a maker-checker mechanism or a pre-authorization before a transaction is processed. So these are some examples that show us the controls in place to safeguard things from going wrong. Right? Detective control, on the other hand, are the controls that are kind of after the fact or post facto. They help us realize what has gone wrong, how it has gone wrong, and hopefully has a corrective action plan in place. So they are more reactive controls, right? Examples of detective controls could be mainly any types of reconciliations, whether it's a bank rec or other recs that the corporation carries out would be an example of detective controls. Some other examples of detective controls can be your checks and balances, whether it's physical cash versus cash on the register or inventory. So these would be a few examples of detective controls. And Stephen, you bring an interesting point about the relationship between them. I think both of them are important, preventive for obvious reasons because it prevents an issue from happening in the first place. But a detective control is also important because it helps us test whether that preventive control is designed and operating effectively. And companies now and regulators are also focusing more on the preventive control aspect because it's just easier and quicker to prevent something from happening than it is to kind of fix it after the fact.
Thank you. And you talk about the focus being on preventive controls from the regulating regulatory perspective, etc., for that. I mean, Zubin, what are you seeing from your side in terms of, the adoption of that more preventative sort of control structure and programs versus the detective?
I think the preventive ones, they work more in the favor of the FI, and I think more in the overall financial system, because it also kind of gives comfort to the relevant stakeholders, which could be the regulatory bodies also. And the preventive controls can be further categorized into whether they are process embedded or they are process independent. Because sometimes you need to have a process independent preventive control, or you can have a normal day-to-day BAU process which can be part of the control itself. So I think that's the way it works.
Okay. And I mean, when we talk, Zsombar, maybe you can go through from the the types of controls that we have. Obviously, from a human nature perspective, there's always this thing of unless we have some form of enforcement or policing of that, the natural thing is not to put as much focus on it. For that, what do you see in terms of the enforcement space within those enforcing controls from regulators, from even auditors, etc., on that, both from a global as well as a regional? I mean, I know you've worked across the globe in all of your sort of experience.
I think what we need to find is the right balance and fit for purpose controls for your environment, for your entity, for your structure, processes, and everything. And don't necessarily just follow the formalities of these things, but also adopt what needs to be adopted to your own organization, culture, and everything. And sometimes you forget the regulatory or the enforcement actions are just a reaction to something which went wrong. And you try to, or you better to avoid this to happen with you and your organization. So it's, I think, worth continuously checking yourself and your organization and adopt those controls, be it preventive or otherwise, accordingly.
Thank you. Is that the case for you, Ramesh? That from your experience, is it more that people are actually, that perhaps I'm being a little bit harsh to clients, that they're actually more looking at the value of the use of those controls than necessarily purely a knee-jerk reaction to I don't want to get into trouble?
Sure. Like, I can break your question into two parts. One is about the preventive controls and the knee-jerk reaction, and probably the second one to add to the enforcement part which Zsombar had mentioned. So I think there has been a clear increase on the preventive controls in the recent past, especially after the SVB collapse. Firms have clearly understood that preventive controls are like the security guards in your community. Just because a theft has not happened for the last 1 year, you don't do away with your security guards. So the theft or the untoward incident did not happen because they were there. So firms have understood that this is the role of preventive controls. And today, let the buzzword, what we call the cost cutting, let it not come into play in employing the security guards, i.e. the preventive controls. So that way, that has gained a lot of importance. And to just add on to what Zsombar had mentioned on the enforcement part of it, in my view, internal controls per se is not a separate domain in an organization. It's a part of every domain in an institution, like in the banking industry. Internal control should be a part of credit risk. It's a part of market risk, part of liquidity risk, and to a great extent, even a part of the business units out over there. So I cannot think of having a separate regulation purely catering to internal controls, but what has actually gone right these years is regulators have started incorporating many aspects of internal controls in every regulation or the standards that they are coming up with. We are in UAE, just to take as an example, the UAE regulator, that's the central bank, has come up with the aspect of internal controls in probably most of the regulations they issued in the last 1 year, be it the model risk management, be it the credit risk standards, or the regulatory reporting requirements. So I think this is a welcome move in the right directions from the enforcement authorities to bring in the angle of internal controls very well into every regulation that they're taking care of.
I think that's a very, very valid point, that I think 10, 15 years ago, maybe more or whatever, that the view was always separating the internal controls was with internal audit, and it was a separate thing that was looked at as in isolation, whereas now, I think there are, and it is often driven by these changes that happen in the structure and how we address things from a business and regulatory perspective are driven by certain macro events, by certain things that have sometimes things that have gone wrong, sometimes things that have gone right. We learn probably the most from the mistakes we make from that, and we'll go into some of those a bit later. But, I think maybe, Zubin, for your, from your perspective, how have you seen sort of, how businesses and the regulators have reacted to those events that, that Ramesh is talking about, now you're talking that internal controls is an integral part of operations, not as a compliance function on its own.
So basically, in the world we live in now, any macro event is not an isolated event. We need to, and none of the regulators or an FI can ignore it, saying that it's not going to impact us. It means we need to assess even a macro event because we don't know when it's going to have a domino effect, which is going to hit all of us at any point of time. So the way I would look at it is at an institutional level, we need to have an internal control assurance framework, which basically uncovers the whole institution's risk management, internal controls, corporate governance, which is very important nowadays, which actually lays the foundation of how things happen, the tone from the top. So it's macro or micro, any event which takes place is going to impact us some way or the other. So it's to one's own disinterest that we are going to ignore it. So I think regulator of any region or an FI, the fact that we are in the globalized market, we need to pay attention to even macro events.
Thank you. And I think in addition to some macro events, you've got the, how we're changing in terms of the way we're doing business. And I don't know, for those of you that may have been here yesterday at the conference, we're talking a lot about technology within finance, the crypto, digital assets, all of this. And, Amaan, maybe, from your perspective, you're sitting in Tarabut as using both technology and the new open banking regulations. How do you see both, that from the regulatory and the internal compliance functions? How are they sort of managing to keep up with all of those developments? Because there's always a thing of, we develop in technology much faster than we develop in regulation. By the very nature of regulation, has to be a step or two behind.
Right, I think, Stephen, you raised a good point by saying that. As we know, in the landscape we are living in currently, technology is changing very fast. Every year we have new iterations coming in, specifically in our sector of open banking around account aggregation and payment initiation. It's changing very fast, so regulations sometimes do not tend to keep up pace with the change in technology. Some of the things we do in our industry of the fintech sector is most of the regulators in the UAE and in the region offer a controlled regulatory sandbox environment. That's where fintechs like ours can go in, kind of test the market, test a few API calls before we go live and just come out with certain issues and reports. Also, we tend to hold, some of the regulators here do a great job in outreach sessions and consultation papers, which kind of give us a broad guidance on what we are supposed to do, either indexing it to an international framework that they intend to look at before they come out with the formal regs, or giving us via consultation guidelines across the industry, just to level set the playing field for each of the licensees within that domain.
Thank you. Just talking on the topic of sort of all the changes that have happened and some of the drivers for it. one of the things, Zsombar, maybe I could ask you is, post the 2008 financial crisis, there's a lot of press, etc., blaming regulators, blaming financial institutions for the failures and the financial crisis that we have. Yet it always frustrated me and confused me as to why there was very little blame on the third party of that, which is the actual customers for it. And there is always a balance to be had. There is the regulator there to regulate the market. Finance is there to do it within the rules, etc. And that. But the customers also have some sort of responsibility and blame. How do we balance all of that together in a proper and useful way for everyone going forward?
I think it's a very good question. So I think we need to recognize that we are all part of this ecosystem. All three of us, the three players you just mentioned, but it's way more complex than that. And while some of the regulations, like here in the UAE, the consumer protection regulations, request us or mandate us to do the relevant disclosures, information to customers and whatnot, it's also part of this ecosystem to help and educate the customers. And in this complex environment where customers have always the latest gadgets, and the 17 years old or the 70 years old have the latest phones with them and the technology, and they have access to the world of finance from A to Z and everything. But do they really know? Do they really understand? As bankers, do we really understand the products, the services, the journeys that we offer to clients? And the same with the regulators. So that's why I think the partnership with the regulators should be expanded to partnership with our customers together, so then we can act together towards to build better, secure, and more protected ecosystems.
Ramesh, maybe do you have any thoughts on that from your?
Yeah, definitely. We all heard of this term caveat emptor in the contract law, right? So it basically means let the buyer beware. There's a lot of responsibility on the buyer to be responsible for the choices he makes and the decisions he takes. So here the buyer is akin to your end user, as you mentioned. I'm not a proponent of this caveat emptor theory where you hold the buyer responsible for everything. Hold the financial institutions responsible, but not bearing the entire brunt to the last decimal of the responsibility quotient. If they have shown slackness, penalize them. Penalize them for any kind of a mis-selling, lack of appropriateness, lack of compliance to controls and stuff. But it's also equally important that the regulators pay some attention, the community pays some attention in educating the end users how better they should handle money, how much of a caution they should take in handling their money. It's a diversified world. Today we are getting into the world of bitcoins and crypto. As an end user, as a customer, if you're not aware of the risks out over there, it's not just the financial institution landscape which can take the blame for it, but it has to be not a shared blame, but there needs to be some sort of an accountability from the end users themselves. And I'm happy that certain European regulators have actually started having these education and awareness sessions for the end users to educate them of the new risks that are coming out of technology getting into the world of compliance and the world of risk management. So it's a welcome move.
Yeah, I would just like to add that there is a responsibility on the FI also to educate and make their own internal employees who are dealing with their products, which are a bit sophisticated, to give them the right kind of training. That's probably one of the reasons where the bridge between the digital assets from the FI to the client is lost, because the RMs or the front line itself is not actually aware of how to go about it, but they are asked to sell it. So they go about selling it to the customers, who themselves also are not educated to that extent. So I think all the stakeholders need to be trained appropriately, so this whole thing of conduct risk is taken care of in proper way.
Thank you. I think there probably is a perception, that if you're an RM or something like that, there's an automatic perception that you understand and you know all of that. that these things are done for it, and perhaps sometimes we have to tie up those loose ends. And I think that segues rather nicely into the next area where, as part of the title is audit, right? Another continually misconceived statement or whatever, area of business is, everyone always will turn, many people will turn to me and sort of make statements along the lines of, these are audited accounts, therefore, why on earth would you ever question them? The fact that we question everything is irrelevant, but they turn around and say, it's audited, therefore everything must be fine. And there is we can go on as a panel in itself as to sort of trying to explain what the purpose of an audit is and, and what it actually does do. And, audited statements have a use and a purpose for it, but too often you see people will assume that they are absolutely perfect. I think the US regulator recently came out, and I think that made an announcement that they had the highest number of failed audits in their review of audits. EY recently admitted that as part of that, that 46% of their audits that were reviewed by the US regulator were found to be below standard of that, right? And I think one of the things that we often do within financial institutions, et cetera, is take on the audited financial statements and take them as, as being perfect. From a risk perspective, and I think this goes to everyone, but maybe Zsombar, if we can start with you, to what extent can you rely on audited financial statements in your risk assessment?
There are some interesting developments happening, for example, in the US, questioning the audited financials of a very famous person and his family now, whether those are true records or not. But so I think, yes, as a financial institutions, look, there are many data available, many information available, so don't just look at the papers, look behind the papers and understand the circumstances. Do your background screening searches and whatnot, asking and challenging even yourself and your understanding of behind those numbers which are shown and stamped by someone at some point in time. So I think it's worth checking, and there are many information, or I can say, available in many sources, other sources, to check and validate the information itself.
Thank you. And Ramesh, go on.
Sure.
Please.
So we deal with these audited financial statements probably on a daily basis, right? So as a panel, we all know audited financial statements form the base for your risk assessment. They act as a good starting point for the risk assessment. It is a means for you to assess risk and not the end. The issue today is we have treated audited financial statements as the end point of assessment. If everything is right there, then the analysis, we say, oh, the client or the counterparty is really good. But the issue we are facing, the problems that come are from those entities where the audited financial statements actually look amazing, you cannot point a fault out over there. So my suggestion is, take it as a starting point, and once you take it as a starting point, build the areas of assessment that you need to do. When you get into this, you will find multiple different points where you need more information, more analysis. And when you build your assessment on those grounds, you will be surprised. The number of inconsistencies you find in what you see actually and what you see in the financial statements is not just handful, but many. So it's very important for us to build the areas of assessment from the audited financial statement, leave it there, and use the areas of assessment to arrive at a decision, and don't arrive at a decision just based on what you see in the statements.
I think that brings to an interesting, and I'll come to you, Amaan, in a minute, but I just wanted to keep on the same topic. Is Zubin, you mentioned before sort of making sure that the RMs are trained and understand what they're doing. You're making the point, don't believe everything in the audited statement. That's music to my heart, in terms of sort of always question it. Healthy degree of skepticism. How do we do that? Do we need to train the RMs, other people that are effectively placing a little bit over-reliance on audits?
It means the audited financials are imperative to complete the picture or to give you a better sense of the whole way of functioning of the entity. But I think what's also important is that the RMs or the front line needs to understand the governance of the whole entity, how it's functioning. The audited financials give you one window to it, but sometimes to understand how the governance is functioning, who are the actual beneficial owners, who are the owners, how the structure is in place, and how that structure actually operates, whether the management is separate from the board members, so on and so forth. So I think the basic understanding of this whole governance part needs to be given to the front line, so they are better equipped when they go on and get the relevant details. They do assess all these aspects, obviously making sure the audited financials is part of it, but it probably will give them a more holistic view of how things work. Yeah. And then the assessment can be reached accordingly.
Okay, thank you. I think that's very sensible. So Amaan, just to go on sort of with Tarabut, obviously, from your sort of client verification process and onboarding of corporate clients, to what extent do you or can you place reliance on the audited financial statements within that process? And can you also supplement this with the sort of open banking regulations, or how does that tie up?
Yes. So if we are being a technology firm, we integrate with corporate clients, but we also integrate with entities we tend to share our technology and IP with. So as everyone just mentioned, I echo the same thing, that audited financials is a starting point, right? We would see if it's been, at least 3 years of audited financials, a tier 1 auditor, etc. But for us, more importantly, because technology is involved, so we tend to look at cybersecurity along with the audited financials very closely, whether they're ISO certified, whether they have done their penetration and vulnerability assessment testings, and if they have the cybersecurity certificates. Also, we would look into see that if they are complying with the open banking regulations that cover account information and payment initiation. So there are certain regs around APIs, data transfer, data protection, anonymization of personal identifiable information. So these things would also supplement us along with the audited financials, just to get a whole perspective, just to get a whole corporate governance perspective, to make sure that not only are the financials fine, the overall company who we're going to be integrating our tech with and sharing our intellectual property is functioning adequately.
Great. Thank you. And I think they're all really, really very good points that we do need to sort of perhaps enhance on the training and the understanding. I don't think we're going to be able to clarify the situation entirely with everyone on this, but one of the fallouts that happen as a result of these audit failures, you have, I think if we go back to the collapse of Carillion in the UK, as a result of that, there was, everyone was screaming blue murder. There were all sorts of promises and threats made to both the audit community, to which not very little has happened, but also to the business community, in terms of the politicians in the UK turning around saying that they were going to set up a whole new major set of reforms in terms of governance within the businesses. But nothing has come to fruition out of that. There's been various pushback. I think there were drafts put together in terms of the governance structures that they wanted and the controls to put in place, to which the businesses have pushed back and sort of saying, screaming that it is too expensive, too cumbersome, too difficult to implement, that it would be prohibitive to running, to doing the business. And I think one has to realize that there is a natural requirement for businesses. Businesses do need to make profit. That's what they're there for. And it is, there is a really tough balance to get. And maybe Ramesh, maybe if you could give some of your thoughts as how do we get that balance in, the controls and compliance versus, what we need to do in terms of, businesses need to be agile. They need to be profitable. Otherwise, they won't be around and they won't be able to do anything.
Now, a very relevant question based on what's happening in today's world. Risk needs to be taken. We cannot avoid risk. Let's be very clear about that. Without risk, there is no reward. And in today's world, the number of risks, the dimension of risk is actually growing faster than ever. So there is a clear growth in risk. But at the same time, you need to grow. So, like they say, sharpen your axe before you start cutting. I would say, sharpen your risk management capabilities before you start growing. Because you don't want to reach a point and then suddenly fall, realizing you were not aware of a risk that was there, or you didn't take enough precaution to handle that risk which was there. So to me, it's about there is a clear growth of risk in today's world, macro, micro, put everything together. At the same time, there is also a risk when you grow. So it's about balancing the growth of risk to the risk of growth. And you do that if proactively you start building your risk management and control capabilities before you start growing and not as a reaction. But the problem in today's world is, what I see, probably my panelists will agree, we see this as a reactive world. Reaction is good from a better late than never perspective. But we would do a world of good if we get proactive. Might be, sounds like a utopian word. Everyone from Stephen Covey talks about being proactive. Even if proactiveness is not possible, I'm fine with it, provided you take an action after your reaction. I've seen institutions where a risk event happens, they take a knee-jerk reaction immediately, and then nothing is done. 3 years later, the same risk event happens, again the same knee-jerk reaction is taken. To me, it's an issue. It's a big issue. Taking the same action for the second time is fine, but taking the same reaction or showing the same reaction for the second time is a result of inaction in the past. If you're talking about risk management and internal controls, we need to be in action and not a victim of inaction. I think if we take care of these, probably you're opening yourself to balancing between growth and the requirements of internal controls and risks that are coming up.
Yeah, and so it's saying learn from the mistakes, right? We are going to make mistakes. It's the nature of business, it's the nature of taking risks. Not everything works out perfectly, but we have to react to it and take action with it rather than just, and sort of questioning it when it first happened and then leaving it be afterwards. So it's sort of paying lip service from that. I think, Amaan, maybe you could give your perspective of that same thought is, from is a technology that can help us to sort of try and address some of this.
Right, so before answering that, just to chime in on what Ramesh said, that in the tech sector, this is even more prevalent because we're growing at such a fast pace. Technology is changing at such a fast pace, so oftentimes it's us trying to fail fast and then come up with identifying the right risks and controls in place rather than the other way around. But yes, technology, to answer your question, Stephen, technology can be used in predictive risk and kind of addressing what kind of risks are going to be in place for us to incorporate before we actually embark on the new activity or the new product that we are planning to get into. Some examples we can take are for quite a few of our new products and new activities, we are required to conduct an ORAP, which is called an operational risk assessment process. So this looks at the operational and cyber risks around something new we plan to get into. These are shared with management, risk acceptances are taken, and sometimes these are shared with the regulators in the form of an NOC. So while this may take a little longer to launch, just going to what Ramesh said, we make sure to have the risks identified and the controls in place before we embark on this new activity.
Okay, thank you. And Zubin, sorry, just I wanted to sort of talk on, Ramesh was making the comments and Amaan was making the comments about risk and addressing risk and all of this. And I think, one of the things is, you said, make sure you build the risk before you build your business, right? And it is invariably the problem. We build the sales side before we build the compliance side of it. A massive example of that would be, in my view, is SVB, which collapsed. There was no chief risk officer in the bank for a period of 8 months. I mean, that seems like a blatant sort of failing in that regard for it. But, I mean, what is the industry going to change? Is it going to address those sort of things, than allowing something as significant as that to be unaddressed for such a long period?
I think it's got to boil down to the regulators pushing it more. And it's imperative that the regulators make it mandatory that these lapses do not take place, because if someone is not in place for 8 months, the regulator would be aware of it, and that's what they need to do, because there are certain segments which they just let it happen just to ensure that giving time to everyone. But I think the regulators need to enforce that it's in place. And from an organizational perspective, I think it's imperative that every organization carves out its own risk management framework, very well knowing that what's the risk appetite it has, and what's the tolerance level to which it is ready to go. And within that, you can confine your business plan so that you ensure that the interest of the organization is paramount in all respects.
Thank you. And I see we are almost over time, but I'm going to just ask one question for each of you, just as a final question. We touched on it before, but obviously there's always this analogy in the region that or in the sector that the corporate businesses are the wolves, the regulators are the sheepdogs, and we the consumers are the sheep. And we've all got our own place in it. We've talked about there's a shared responsibility and all of that. And my question to you is, from your perspective, how do we see the future of sort of internal controls and compliance to be able to create a value add to that and bringing in that shared responsibility rather than the siloed analogy that there is? So, Zsombar, maybe we start with you.
It sounded very ECG compliant sort of a question with this illustration. Thank you. Absolutely. So first and foremost, I think those who sit on the second line or the third line, I think it's the time to leave your ivory towers and move out and I'm not saying socialize, but understanding the business and speaking the same language with the business together. But at the same time, the business or the front line should understand the concept of these controls that we talked about, the internal audit mechanisms and controls and everything around. So we collaboratively can address these things which are growing adequately and respond to them.
Right. Thank you.
I would suggest 2 things that institutions need to take care of. Invest in technology and systems. That's going to be important from an internal controls and risk management perspective. But at the same time, there is no substitute to human expertise and human judgment when it comes to risk management and internal controls. How do you strike this balancing act? It's an art. Probably we can have another debate or discussion around that itself. And the second thing I would want to suggest is, all that we have discussed today in this panel can come to life only if there's a cultural mindset change in the institutions towards risk management and internal controls, else it will remain where it is.
Thank you.
Being in a tech firm, what we typically do just to make sure that we have the greater good of the industry covered is that we typically reach out frequently to the tech and innovation departments of the regulators, We tend to have some sessions with them, consultations, discussions, and when the regulators do come to do our technology and operational thematic reviews and risk assessments, that's how we set the playing field across the different licensees, just to make sure that this is for the greater good of not just the industry, but the entire ecosystem and our customers as well.
My fellow panelists have covered it quite well, so I would just simply say that we need to, just two words, we need to collaborate and we need to partner with the relevant stakeholders. And once we do that, I think we will all be moving in the right direction together. Thank you.
Thank you. I think those are great 2 words to end on. I know we've gone over time a bit, but thank you very much for your very valuable input on this. Hopefully everyone has enjoyed the session.